A few weeks ago, I did a video on one part of Trump's tax plan, which was about the elimination of income taxes. If you want to check out that video, the link is in the description. Today, I want to focus on a part of his plan that I believe is more important than a supposed elimination of income tax or any of the policies that he or Harris is proposing. And that's Trump's plan to make permanent the Tax Cut and Jobs Act, also known as TCJA or Trump tax. Okay, so what is the TCJA? Well, the Tax Cut and Jobs Act of 2017 is the unofficial name for the largest set of changes to the revenue tax code since 1986 and signed into law by President Donald Trump in 2017. The TCJA made many large changes across multiple areas, including, most infamously, reducing corporate tax rates, increasing the standard deduction, and increasing the exclusion amounts for estate taxes. However, only some of the changes were permanent and over 20 provisions will expire by the end of 2025. And this is a problem because these changes benefited all Americans, not just the rich. So let's talk a bit about some of the key changes that were a benefit to not only the wealthy, but the middle class. Not only big businesses, but small businesses, and most certainly real estate investors. First, the tax rates were reduced. Before TCJA, tax brackets were 10%, 15%, 25, 28, 33, 35, and 39.6%. After TCJA, they came down to 10, 12, 22, 24, 32, 35, and 37%. For the average middle-class household with an income of $100,000, if you were, let's say, single, you fell into the 28% tax bracket. Married or head of household, you fell into the 25% tax bracket. However, after the TCJA, the same income for a single person was now taxed at 24% instead of 28%, and married couples taxed at 24%. Next, the standard deduction went from being singles benefiting from a $6,300 deduction, those filing head of household a $9,300 deduction, and married couples a $12,600 deduction. But after the TCJA, singles received a tax deduction of $12,600 instead of $6,300. Head of households received an $18,000 deduction instead of only $9,300. And married couples received a whopping $24,000 deduction instead of the $12,600 deduction that was previously instituted. So for comparison, before the TCJA, and after the TCJA. Okay, moving on. Before the TCJA, business owners could only deduct up to 50% of their meals and entertainment expenses. Afterwards, while they could no longer deduct entertainment expenses, their meals expense became 100% tax deductible. Now, how many of you foodies would like to deduct 100% of your eating out? I mean, of course, while discussing business. But since Trump administration, the meals deduction has been decreasing each and every year, unfortunately. Now, before the TCJA, there was no bonus depreciation or ability to pair depreciation, IRS Code Section 179, and bonus depreciation. But after the TCJA, business owners could apply all three for a mega tax write-off. Now, let me give you an example so you can understand this level of goodness. Basically, if you bought a $50,000 car, by pairing all three of these tax codes together, you could potentially write off the entire $50,000 in 1 year. That will wipe out many of your tax liabilities and then some. Now, to help you understand how that will work with, let's say, real estate, I'm going to get some help from some of my animated friends. Check out this short video. Next, before the TCJA, there was no such thing as QBI, which stands for Qualified Business Income. Afterwards, business owners can take advantage of the QBI, which basically removes 20% of their income so that it is tax-free. In other words, let's say your net income, your net business income that is $100,000. QBI says take off $20,000 and only pay taxes on $80,000 because that's how I roll. Thank you, Mr. QBI. Here's another one. Before the TCJA, Americans who work hard all their life with the intent of leaving an inheritance to their loved ones, like a house, also left a tax burden along with their house should their heir choose to sell their inheritance, which is what many do. But after TCJA, the stepped up in basis was instituted, which allowed an heir's inheritance to step up in basis to whatever the current market value is. So if they want to sell the house, they can sell it at the current market value, and that means their tax liability would be zero. Which, by the way, the Harris tax plan is seeking to reduce or eliminate this. You want more information about the Harris tax plan? Check out my video. The link is in the description. And finally, before the TCJA, the corporate tax rate was 35%. Afterwards, it's 21%, and Trump is talking about reducing it even lower to possibly 15%. Now, I will applaud Vice President Kamala Harris because Bidenomics wanted to change this to 39%, but she's only talking about increasing it to 28%. Now, I know what you're thinking. Big corporations need to pay their fair share of taxes, but let's be clear, big corporations are responsible for many jobs that the middle class hold. And if big businesses feel punished for success, guess what? They can pack up and go to another state or country that is more tax favorable or shut down business altogether because they have enough amassed wealth and don't need that business. And if they do that, guess who suffers? The middle class, who can't just pack up and roll out. And guess what else? They may find themselves on the unemployment line. Listen, this is just some of the tax benefits of the TCJA, and they are set to expire at the end of 2025. Vice President Harris has openly expressed that she doesn't plan to stop nor extend them. Trump is planning to make these tax changes permanent. I have a question for you. If you're a middle-class individual without a business, do you want to go back to higher tax brackets, low standard deductions, and an increase in your FICA taxes? If you're a business owner, do you want to lose your ability to write off 100% of your meals expenses and lose the ability to make 20% of your net income tax-free with the QBI? And if you're a business owner and or real estate, do you want to lose your ability to depreciate your assets and reduce or eliminate your tax liability altogether? Now, if you're saying, hey, Kinite, I'm middle class, I'm a higher earner, and I am frustrated because the wealthy pay less taxes than me, and I am tired of the brunt of the tax burden falling on me. It's time for the wealthy to pay up. Listen and hear me clearly. This is not the way. The way is to learn the game, not hate the players of the game. And stop running to cheap tax prep companies to get your taxes prepared, but start working with a tax strategist to develop a tax plan so you too can stop giving Uncle Sam a tip every year. This is what the wealthy understands. That is, there is a difference between tax preparation and tax planning, and a good tax strategist can help you levy the legal tax code so you too can reduce or eliminate your tax burden. But if you want to just keep getting your taxes prepared, and if you're okay with going back to this archaic way of taxation that robs you of your hard-earned money, then to each his own. But if you are not okay with this, I suggest you give great consideration to the economic policies at hand and the difference between tax preparation and tax planning. Now, I've said it before and I'll say it again. These videos are not an endorsement for or against any candidate, just an attempt to provide you with the plan so that you can make an informed decision. If this information was helpful, do me a favor and like, share, and subscribe so that you don't miss important tax and business tips and updates, as well as help others get this information by sharing. Talk to you soon. Listen, I'm on a mission to make sure you protect your hard-earned money, no matter who wins the presidency. That's why I want you to join me at the Tax Strategy Conference, October 21st through 23rd, from 7 p.m. to 9 p.m., where I'm going to teach you the secrets to living a tax-free life just like the wealthy. If you're tired of overpaying IRS, having too much withholding taxes taken out of your paycheck, or paying capital gains on your real estate sales, you can't afford to miss this event. Register today. You'll be glad you did.